what I want to talk about today, just a couple of general market comments. When the last time I appeared on this show, or on the site rather, I talked about really four horsemen that were affecting the markets, affecting investor perceptions. One being the Gulf oil spill, another being the European debt crisis, and the worry that that would turn out to be a contagion that would create conditions similar to what triggered the market crash in 2008. Rising regulation, particularly emanating from Washington in the Obama administration. And then finally, concerns about taxes also emanating from Washington. Well, I wish I could report, really solid progress on all these issues, but I think we can see at least some favorable developments coming out in some of these. Obviously, the Gulf oil spill remains a complete catastrophe. I think the oil continues to flow out of there. BP's potential liability is rising. As I said before, I think people that are conservative income investors have no place in this stock. Rather, take a look at those other super oils like Chevron, Exxon. I mean, they're up there at Congress too, and they're taking flack, and their costs are going to rise as well. But they really have an opportunity to benefit from BP's errors and learn from its mistakes without the financial liability. And in fact, there's been a rumor that maybe they will be acquirers at some point of some of these BP assets. Really depends on what happens with BP. I can't predict what's going to happen. I mean, like everybody else, I'm hopeful that they will cap this spill, but as long as it's not capped, the potential liability continues to grow. So that's not a positive for them. But again, as with the super oils, as with onshore stuff, a very big positive for efforts in that direction. And just because we don't get energy from offshore doesn't mean we're not going to need it from somewhere else. So, again, you might want to check out an article in Personal Finance I wrote with David Dittman on the oil sands. They're a beneficiary. Elliott Yu has written quite a bit in his Energy Strategist as well. So there are positives there as well as negatives. The second thing, the European debt contagion, I do think there are positives in that area. And what we've seen is basically the interest rates have remained fairly in check. Borrowing costs have remained pretty much in check. Some of the rates like LIBOR, you look at the TED spread, which is Treasury bills versus Euro dollars, they've remained relatively steady, or at least at pretty low levels, well below the levels we saw in 2008. So there's no evidence that there's a credit contagion. There's certainly a lot of evidence of a lot of fear out there. And in fact, companies may be having to pay a little bit more when they go to the bond market. But this is nothing close to 2008. And just a big difference that I don't think it's pointed out enough in the press is that sovereign debt is a lot easier to keep up with than that mortgage-backed security debt or assets that were just bank balance sheets were just riddled with them, and no one knew where they were, what their origins were. It's a tremendous information gap. That's one of the main things that triggered the tremendous fear that we saw. But that is not the case today. Again, as scary as it might be to see Greece downgraded to a junk rating, but this quantity of debt is known. It's great. But just knowing where the extent of the damage is, tremendous difference, and makes all the difference in the world in any kind of financial panic. Again, the market abhors a vacuum, and when there is one, that's when bad things tend to happen in magnitude, in orders of magnitude. Regarding regulation and taxation, this has also, I think, been magnified by fears. There are some legitimate worries out there. I think certainly the offshore oil industry is going to see a lot more regulation, and their costs are going to go up because of it. But again, I don't think that that's breaking any new ground as a prediction. I think that's pretty much something that anyone with any common sense would see. Other areas of the business, though, how about onshore drilling? Again, you got to have this oil from somewhere, and what we might be seeing there is actually something that will actually help the industry going forward. Maybe some clear guidelines to help them actually increase investment there. So, and in the oil sands of Canada as well. A lot of support there. So, I mean, there are always winners and losers from these things. I think you have to keep an eye on regulation for the utilities. I don't see any evidence that regulation is deteriorating in any meaningful way around the country. Companies are still getting pretty nice deals on rate increases. There's a nice cooperative relationship going on there. The exception would be Florida. I don't see a lot of improvement there until Mr. Crist exits the governor's mansion, and even then we're going to have to see what happens. But by and large, pretty positive regulatory environment for utilities. And again, you have to just sort of watch what the government does, and that's what we do in our publications, and particularly Utility Forecast are very much focused on that particular issue. Regarding taxes, again, we're going to have to see what happens. The most important issue is the dividend tax cut or that Bush put in place, where you have a maximum rate on 15% on dividends. There's a lot of support in Congress, and in fact, the Obama administration to extend this and possibly by raising the rate to 20% on the top rate. But again, keeping these rates in place. But there's a lot of uncertainty there. I think, again, my view is that if anybody is going to be selling into this uncertainty, it's going to be a nice time to pick up some nice yields. In the meantime, let's stick with our good businesses, and that's how we're going to make money over the long term. So thanks for tuning in.